In the world of finance, there are few figures as respected as Warren Buffett. Known as the Oracle of Omaha, Buffett has guided Berkshire Hathaway through countless market cycles. His investment philosophy, grounded in value investing, has made him one of the most successful investors of all time. Yet in recent years, even Buffett, a pillar of confidence in the markets, has taken a cautious stance. His actions signal a shift in sentiment, one that has many investors wondering if another market collapse is imminent. Why is Warren Buffett raising so much cash? Why is Berkshire Hathaway trimming significant stock positions? Are these actions a sign that the market is dangerously overheated? These are the questions that haunt investors today. This script will delve into Buffett's positioning, explore market parallels with the dot-com bubble of 2000 and the 2008 financial crisis, and examine recent bank failures which echo the early signs of previous collapses. Ultimately, we'll uncover whether we are on the brink of another major financial disaster. Part 1. Warren Buffett's cash hoard and portfolio reductions. To understand Warren Buffett's recent actions, it's important to look at what he has historically prioritized in terms of investment strategy. Buffett is a value investor who seeks out companies with strong fundamentals that are trading below their intrinsic value. He often buys and holds stocks for decades, and his long-term horizon is one of the reasons for his incredible success. However, in the last few years, Buffett has been accumulating a massive cash reserve. As of Q2 2024, Berkshire Hathaway's cash pile reached a staggering $276.9 billion, a record high. More than half of this amount, around $234.6 billion, is in US Treasury bills, a safe but low-yielding investment. At the same time, Buffett has been selling portions of key stock positions, including Apple, Chevron, and Bank of America. Buffett's actions seem to be signaling caution. As of mid-2024, Berkshire Hathaway has sold a net $75 billion worth of stocks. The question is, why? In Buffett's own words, it's just, things aren't attractive. He has voiced concerns about inflated valuations in the stock market, especially in sectors like technology and artificial intelligence, which have been at the center of a speculative frenzy. Buffett's reluctance to deploy capital suggests that he believes the market is overpriced, and he may be waiting for a correction that would present more favorable opportunities for long-term value investments. Part 2. Market Parallels, Dot-com Bubble, 2008 Financial Crisis, and Today. Buffett's cautious behavior may not come as a surprise to those familiar with the cyclical nature of markets. History provides ample examples of speculative bubbles that led to catastrophic crashes. Today, many of the conditions present in the market bear striking similarities to the dot-com bubble of the late 1990s and the 2008 financial crisis. By examining these events, we can better understand the risks in the current market. The dot-com bubble, 1999 to 2000. The dot-com bubble was a period of extreme speculation in technology stocks, particularly internet companies, during the late 1990s. Investors poured money into tech startups, many of which had no viable business model, no earnings, and in some cases no revenue. The belief that the internet would revolutionize every aspect of life led to soaring valuations for companies that were often little more than ideas on paper. For example, companies like Pets.com and Webvan raised millions of dollars from investors, only to collapse when the bubble burst in March 2000. The Nasdaq, home to many of these tech companies, plummeted from its peak, losing nearly 80% of its value by the time the market hit bottom in 2002. The key factor driving the dot-com bubble was irrational exuberance, the belief that these companies would dominate the future, regardless of their current financial performance. Investors overlooked fundamentals and focused instead on the potential of these companies to transform industries. Today, we see similar levels of excitement around emerging technologies such as artificial intelligence, cryptocurrency, and clean energy technologies. Stocks in these sectors have seen meteoric rises, driven by speculative buying and lofty promises about future innovation. Some analysts are warning that many of these companies are overvalued and that we may be witnessing a new speculative bubble. Comparing valuations then and now. The similarities between the dot-com bubble and today's tech market are striking. In the late 1990s, the price-to-earnings ratios of tech stocks soared to unsustainable levels. Companies were trading at multiples that reflected future expectations rather than current earnings. Similarly, today we are seeing tech companies, especially those in the AI and clean energy spaces, trading at sky-high valuations. Companies like Nvidia and Tesla have seen their stocks rise exponentially, despite questions about whether their earnings can justify their current valuations. The Nasdaq, which houses many of these tech giants, continues to reach new highs, prompting concerns that another bubble may be forming. The 2008 financial crisis. While the dot-com bubble was driven primarily by speculative investment in tech stocks, the 2008 financial crisis was fueled by excessive risk-taking in the housing market. During the early 2000s, banks and financial institutions issued a large number of subprime mortgages to borrowers with poor credit histories. These risky loans were bundled into mortgage-backed securities and sold to investors as safe investments. When the housing market began to cool in 2007, defaults on these subprime loans skyrocketed. As the value of mortgage-backed securities plummeted, financial institutions that had heavily invested in these products began to fail. Bear Stearns, once a titan of Wall Street, collapsed in March 2008 after its exposure to subprime mortgages led to massive losses. The tipping point came in September 2008, when Lehman Brothers filed for bankruptcy, triggering a global financial crisis. Stock markets around the world plummeted, credit markets froze, and governments were forced to step in with massive bailouts to prevent the collapse of the entire financial system. The key lesson from the 2008 crisis is that excessive leverage and poor risk management can have catastrophic consequences for the financial system. In the years leading up to the crisis, banks and investors had become overly reliant on the assumption that housing prices would continue to rise indefinitely. When that assumption proved false, the entire system collapsed like a house of cards. Parallels with today's market. Today's market, while not driven by subprime mortgages, still shows some worrying signs of excessive risk-taking and overvaluation, particularly in the tech and AI sectors. Corporate debt has also reached record levels, with many companies taking advantage of low interest rates to borrow money cheaply. As interest rates rise, these companies could face increased difficulty in servicing their debt, which could lead to a wave of corporate defaults. Additionally, private equity and shadow banking have grown significantly since 2008, creating new pockets of risk that may not be fully understood or regulated. These non-bank financial institutions often operate with less oversight than traditional banks, making them more vulnerable to liquidity crises and market downturns. Part 3. Bank failures. The first signs of collapse, then and now. Throughout history, bank failures have often been the canary in the coal mine, signaling deeper problems in the financial system. This was true in 1907, 1929, 2008, and even more recently in 2023 with the collapse of Silicon Valley Bank. The panic of 1907 was triggered by the failure of the Knickerbocker Trust Company, a major financial institution in New York. The collapse of Knickerbocker set off a chain reaction of bank runs and financial panic, which ultimately led to the creation of the Federal Reserve in 1913. The lesson from 1907 is clear. When trust in the banking system erodes, the entire financial system is at risk of collapse. In the run-up to the 2008 financial crisis, several high-profile bank failures foreshadowed the broader collapse of the financial system. Bear Stearns, a major investment bank, was one of the first casualties, collapsing in March 2008 after two of its hedge funds, which were heavily invested in subprime mortgages, failed. This event marked the beginning of the end for the housing bubble. As the crisis worsened, other banks, including Lehman Brothers, Washington Mutual, and IndyMac, also failed. The collapse of these institutions sent shockwaves through the global financial system, leading to a credit freeze and a severe economic downturn. Recent bank failures in 2023 to 2024. In March 2023, the collapse of Silicon Valley Bank, or SVB, sent ripples through the financial world. SVB, heavily exposed to the tech sector and long-duration bonds, faced a liquidity crisis as rising interest rates devalued its bond holdings. This, coupled with a sudden run on deposits, led to the bank's failure. SVB's collapse triggered fears of a broader contagion, especially as the bank's exposure to the tech industry mirrored some of the speculative bubbles of the past. Within days, Signature Bank also collapsed, and First Republic Bank followed soon after, marking the first significant banking failures since the 2008 financial crisis. These banks were particularly vulnerable to interest rate risks and had concentrated their business models around sectors like technology and real estate that were hit hard by changing economic conditions. While the government stepped in with emergency measures to protect depositors, the failures revealed significant vulnerabilities in the financial system, especially among smaller and mid-sized banks that were less rigorously regulated than the larger institutions. This situation eerily echoes the early failures of Bear Stearns and Lehman Brothers during the 2007 to 2008 financial crisis, which escalated into a broader systemic collapse. Part 4. Examining common triggers of market crashes. Throughout history, stock market crashes have been triggered by a combination of factors. Whether it was the overvaluation of stocks, excessive leverage, or poor risk management within financial institutions, crashes tend to follow familiar patterns. Below are some of the most common triggers that have played a role in past financial crises and could potentially signal future market corrections. 1. Excessive speculation and asset bubbles. One of the most prominent causes of market crashes is excessive speculation, where asset prices rise far beyond their intrinsic value based on unrealistic future expectations. The dot-com bubble of the late 1990s and early 2000s is a prime example of this phenomenon. Investors poured money into tech companies without solid earnings or business models, driving valuations to unsustainable heights. Similarly, today's tech and AI boom shares some characteristics with past speculative frenzies. AI stocks, cryptocurrencies, and clean energy companies have seen exponential growth, often driven more by hype than by solid financials. If these overvalued sectors were to correct, it could have a cascading effect on the broader market. Leverage and debt buildup. High levels of leverage within financial institutions and corporations can significantly amplify market crashes. In the years leading up to the 2008 financial crisis, banks were highly leveraged, borrowing vast sums to invest in complex financial products like mortgage-backed securities. When the housing market collapsed, these institutions faced massive losses they could not cover, leading to their failure. Today, corporate debt levels are also at historic highs. Many companies took advantage of low interest rates to borrow cheaply. But as the Federal Reserve continues to raise rates to combat inflation, these companies may struggle to service their debt. If defaults rise, it could trigger another wave of financial turmoil. Interest rate hikes. Rapid increases in interest rates have often been the catalyst for market corrections. For example, the stock market crash in 1987, known as Black Monday, was partially triggered by rising interest rates, which increased borrowing costs and reduced liquidity in the market. The Federal Reserve and central banks around the world are currently raising interest rates to combat rising inflation. Higher rates can slow economic growth, make it more expensive for companies to borrow, and reduce consumer spending. This environment increases the risk of a market downturn, especially for sectors that are highly sensitive to borrowing costs, such as real estate and technology. Systemic failures in financial institutions. As seen in the 2008 financial crisis, the collapse of major financial institutions can send shockwaves through the entire economy. When Lehman Brothers went bankrupt, it triggered a global financial meltdown as credit markets froze and investor confidence evaporated. Bank failures in 2023, such as Silicon Valley Bank and Signature Bank, may be early warning signs of systemic risks within the banking sector. If more banks face liquidity crises due to rising interest rates or deteriorating economic conditions, it could potentially lead to a broader collapse. Geopolitical shocks and economic instability. Geopolitical events and broader economic instability can also contribute to market crashes. For instance, the oil crises of the 1970s led to significant market downturns, as rising energy prices contributed to inflation and economic slowdowns. Today, rising geopolitical tensions, whether related to conflicts in Eastern Europe, trade wars, or supply chain disruptions, have the potential to destabilize global markets. A significant escalation in these tensions could trigger a market sell-off, particularly if key global economies like the US or China are involved. Part 5. Buffett's caution, why he's preparing for the worst. One of the clearest signals of potential trouble ahead comes from Warren Buffett's own actions. Buffett has often said that cash is king during times of market turmoil. By amassing such a large cash reserve, it's clear that he believes the market is heading for a correction or downturn. But why would a long-term investor like Buffett be so cautious right now? 1. Lack of attractive investment opportunities. Buffett has stated that he's struggling to find companies that meet Berkshire Hathaway's stringent criteria for value investing. With valuations at historic highs in many sectors, he's unwilling to overpay for stocks, preferring to sit on the sidelines with cash until more attractive opportunities arise. This restraint signals that Buffett believes the current market environment is overvalued and ripe for a correction. 2. Avoiding risky, overvalued sectors. In recent years, sectors like technology and artificial intelligence have garnered enormous attention from investors, driving stock prices up to dizzying heights. But Buffett, true to his value investing roots, is avoiding the hype. His decision to trim Berkshire Hathaway's stake in Apple is a clear indication that he believes tech stocks may be overvalued and the risks outweigh the potential rewards at current prices. 3. Preparing for a market crash. Buffett's strategy of holding large cash reserves is rooted in his belief that markets go through cycles of boom and bust. During times of economic turmoil, when other investors are forced to sell at a loss, Buffett will have the liquidity to swoop in and buy quality companies at a discount. His long-term success has been built on buying undervalued assets during market crashes and holding them for the long haul. By raising cash now, Buffett is positioning Berkshire Hathaway to take advantage of opportunities that will arise during the next market downturn. His actions suggest that he's preparing for the worst and believes that a market crash may be on the horizon. Conclusion. Are we on the brink of another collapse? The stock market is notoriously unpredictable, and no one can say with certainty when the next crash will occur. However, the warning signs are clear. High valuations, excessive speculation, rising interest rates, and recent bank failures all point to increased risks in the market. Warren Buffett's cautious approach, combined with historical parallels to the dot-com bubble and the 2008 financial crisis, suggests that the market may be heading for a correction. As investors, we should take these signals seriously and prepare for potential volatility. While it's impossible to predict the future, being aware of the risks and taking steps to protect your portfolio, such as diversifying assets, raising cash reserves, and avoiding overvalued sectors, can help you weather the storm. The next market collapse may not be far off. Whether it happens in October, the month of infamous crashes, or at some other time, the key is to be prepared. The gathering storm is real, and only those who are vigilant and cautious will emerge unscathed. Are you ready?
Remember to like and subscribe for more video content. Sapiens quae vigilat.